Hello, ladies and gentlemen. Thank you so much for joining us. MoneyShow is delighted to welcome Tim Quast, founder and CEO of Market Structure Edge. Mr. Quast is a top national expert on market structure, the rules governing the stock market, and founder of two successful market-leading firms providing quantitative data and analytics for navigating the stock market. And please be sure to stick around after the presentation to join Tim for a live Zoom meeting. Tim, thanks so much for joining us. The floor is yours.
Okay, thank you very much, Jessica. So my job today is to talk about what powers these so-called meme stocks. So that term comes from the fact that there's a set of stocks, small group, that have exploded on social media, particularly on Reddit. So you probably have heard something about that. And we have a short time to cover this, so I'll try to make it brisk, but it reminds me of a story. So there was this church pastor who was known for being verbose and taking a long time to get through the sermon. And one time he's speaking and taking his usual long period, and he notices that one of the folks at the back of the church, couldn't have been a very big church, got up and left during the sermon. And at the end, he went to the door, of course, to tell folks goodbye as they're leaving after the church service. And he catches this fellow and he says, "I couldn't help but notice that you left during the sermon, so I wanted to make sure everything was okay." And the man said, "Oh no, everything's fine. I just needed a haircut." And the pastor's a little bit taken back by this and said, "Well, couldn't you have done that before?" And the man said, "Well, I didn't need one then." You have to think about that a little bit, but while you're doing that, let's get started on this. So my job, as I said, is to explain how meme stocks occur. It's not just madness of crowds that does this. And if you want to follow along, go to marketstructureedge.com. You can hit that request a free trial button and put your name and email address in. You don't need a credit card. You get 14 free days, and you can follow along at the end. That's the key here, so that you can see how this data works. And I'll mention too that if you want to hang around at the end, we'll have a Zoom discussion after this, and I'll spend more time on entries and exits. The reason that we have something to say about this at Market Structure Edge is because this is the business we're in. Market Structure Edge is a decision support platform for active traders that started just in 2020. It's a brand new platform, but the data behind it and the data science are not. About 4 years ago, the data that we use today became publicly available. We've been watching, and so we spent a considerable time testing it before making this available. But we build software and algorithms and mathematical models that measure how investors behave. And I started a firm in 2005, thus the long period of data science, called modernir.com. That's the largest provider of quantitative equity market structure analytics. I'll explain that term. To US listed companies. And so trillions of dollars of market cap depends on our analytics to understand what the money's doing. And we're nationally recognized experts for this. In 2017, I was asked by Congress to submit written testimony on how we might improve the market for issuers and investors. And I mention these things because it's the credibility. And we're a longtime national supporter of our professional association, to which I belong for 26 years. It's the Investor Relations Professional Association, NERI. In fact, I'm finishing my stint on the board this year. So that's the background for market structure, a term that you don't hear a lot. It's the behavior of money behind price and volume in context of rules. Price and volume are not metrics, though we all depend on them. They become metrics for most systems, and yet they're consequences of what's occurring behind them. And that's what we want to focus on, and that's what we understand, because the stock market is the Death Star. I mean, a reference to, if you've seen the Star Wars movies, this thing that, the giant thing that the Empire created that destroyed everything. Not that I mean that the market is destroying everything, but it's a way to think about how the market works. So we didn't come up with this. T. Rowe Price came up with it. The Global Electronic Trading Group, they're headed by a fellow that I know well and have been on panels with and have moderated discussions with, was asked by the portfolio managers at T. Rowe Price to describe, well, how come you keep telling us that we can't buy this or that, or we can't get the amount of stock that we're looking for? And he said, well, I'll show you. And he had a team devise this schematic to illustrate what the stock market is like. And you don't have to understand all the details behind it. All that you need to know is that there's a buyer on screen left and a seller on screen right. And in between them is all of this complexity that constitutes the stock market today. And so that has a major effect on how the market behaves. All money under the regulatory structure that we have today has to pass through a broker dealer. You're going to use one. Your online broker is a broker dealer regulated by FINRA. And it doesn't matter if you are aware of it or not, orders are going to pass through algorithms managed by smart order routers, and then they make their way toward the stock market. In our case, as retail investors, almost all of our order flow never even gets to the New York Stock Exchange or the NASDAQ. It will be consumed by brokers in those DPs, those dark pools, broker operated marketplaces before it ever gets there. So then this has an effect on behaviors in the marketplace. That becomes an end unto itself. And so it's necessarily going to change the way that the market operates. It's going to affect supply and demand. And that is what we want to understand, because mathematically, it is 90% likely that the market isn't rational. And I'm not just saying that, we're looking at the underlying data. Only the one on the left, active investment behavior, is rational. That's the only rational element, and it's 9% of trading volume across the S&P 500, data that we track all the time. More than double that is passive investment behavior. That's going to be index funds, exchange traded funds, quant funds. And if you think about this, the Citadel Securities of the world, the Renaissance Technologies of the world, they understand and use market structure, and they're wildly successful, and they fit in that category. And then the next one, fast trading. This is profiting on price differences. And this will be firms like Citadel and Virtu, firms that buy retail order flow, Two Sigma, Quant Lab, Hudson River Trading, Infinium, GTS. There are a bunch of these firms, and all they do is trade their own resources. And they're over half of all trading volume. Then finally is risk management. That's the application of a trade in which the equity leg is dependent on the derivative leg, an option, a future, a swap, and that is what's the end point, not the equity that is associated with it. Well, these are the things that are driving the market. And it's what technical analysis doesn't pick up. It doesn't know what reason prices change, or what the demand is, or the supply is, and how those things may be changing or trending. And that's what we want to understand, because that's what underpins this entire meme stock phenomenon that we've seen today in the market. And it goes far beyond that. But let's suppose now that we've set this up, that's sort of the preamble. If we look at GameStop, let's suppose that the GameStop shareholders who own 100% of the outstanding shares are neither buyers or sellers. There are no shares they're for offer, and no bids from the holders. And yet along comes a whole bunch of retail traders who've been talking about it at Reddit and using Robinhood as their trading platform, their online broker dealer, who jam, we'll call it the pipeline, full of limit orders to buy GameStop. Well, if there's nothing to buy or sell, how could the price go up? Well, sitting in the middle are Citadel and Virtu and Hudson River Trading and Quant Lab and Two Sigma, and they're going to manufacture stock, and that stock will fill at steadily higher prices, and the stock soars. And what should stand out to you out of this data is, well, how can that possibly be true? That market makers manufacture stock? Well, that's what we need to understand. It's a vital principle that helps us know why supply and demand fluctuate. Under regulation national market system, a term that everybody who participates in the US equity market should know, Reg NMS, regulators wanted a continuous auction market where there are always 100 shares to buy and 100 shares to sell, bid in the offer, available for everything. And this was implemented in 2007, came out of regulations implemented through congressional legislation all the way back in 1975. And the regulators and Congress felt that the little guy wasn't getting a good deal. So what if we could have 100 shares available all the time? Well, think about an art auction. What must happen in an art auction is that there first must be art to buy. Art's got to exist first. Then buyers have to demonstrate that they're capable of buying the art that is up for sale, and then an auction ensues. Well, here under Reg NMS, market makers said it would be impossible for them to make a bid and an offer in everything, thousands of securities potentially, all the time without an exemption from the short locate rules. So if you're going to short a stock, you have the trade day plus 3, T plus 3 to verify that you can borrow that stock. If not, you're going to have to buy the stock back that you shorted. Otherwise, you'll be naked short. Well, the SEC agreed that if we're going to have this continuous auction market, that market makers would be exempt from that rule. They're exempt from Reg SHO Rule 203B2, very arcane term, but this is it, that requires everybody else to locate shares. They don't have to do it. And if you think I'm making this up, just see what the SEC says. You could go to Google and Google the short locate market maker exemption, and you will find this, that naked short selling is not necessarily a violation of the federal securities laws or the commission's rules, because broker dealers that make a market in a security generally stand ready to buy and sell the security on a regular and continuous, there's that word again, continuous auction market basis at a publicly quoted price, even when there are no other buyers or sellers. Well, then where's the stock going to come from? Well, we find out right here. Thus, market makers must sell a security, not may or can, they must sell a security to a buyer even when there are temporary shortages of that security available in the market. This may occur, for example, if there is a sudden surge in buying interest in that security, and they don't even have to arrange to borrow shares. That's what happens with meme stocks. There's a sudden surge in buying interest. So let's put this in terms of Robinhood. This is how Robinhood fed the meme stock craze. It's an online brokerage, of course, and it sells its order flow pipeline to somebody like Citadel, Virtu, Two Sigma, Quant Labs, soon Hudson River Trading, and firms like that. So say there are 1,000 buy orders in the pipeline and 1 sell order. Well, Citadel will immediately take the other side of the sell order and then manufacture stock at steadily higher prices to fill those buy orders until there is a nexus of supply and demand. And then they'll stop filling the limit orders and down the stock goes. This is what is occurring. It causes stocks like AMC and GME to whoosh up even when there are no buyers and sellers. So then let's add in another piece to this puzzle. That is one part of the equation. That is supply, and then there is demand that occurs around this. These two things blend together, but we want to track supply and demand. That's where we're going with Market Structure Edge. So then our friends at IEX, a stock exchange, and there's a great story about them, by the way. If you haven't read Michael Lewis's book, Flash Boys, do it. It is not only wildly entertaining, it lays a great foundation for understanding the stock market. Well, they studied the data around what happens within 2 milliseconds of changing prices. If the bid and the offer begin to change in 2 milliseconds, blink. A blink is about 400 milliseconds. Stocks can trade thousands of times in that period of time. So they looked at the data on their platform and said, well, you've got full service broker dealers like Goldman Sachs, Morgan Stanley, and so on. You've got agency firms like Instinet, owned by Nomura. They don't put up their own capital. They're just going to work orders for customers. And then you have fast traders like Citadel and Virtu and Hudson River Trading and Infinium and GTS and Quant Lab and so on, who don't have customers. And look at the difference. A reaction in 2 milliseconds by full service broker dealers, minimal. Little bit by agency brokers, explosion by fast traders. What does this mean for you and me as retail traders? Well, that fast trading machines know way more than we do about supply and demand. They can see the pipeline because they bought it. They know what's in the pipeline. They have a responsibility to fill those trades because they purchased them, but they own the trades and they know the supply-demand equation. We will never, ever, ever be able to beat them, but we can understand what they do and gain an advantage of even days by understanding supply and demand and how the market works. That's the key. You know, if you're going to be a doctor, you got to know medicine. If you're going to be a lawyer, you got to know the law. If you're going to be a trader, you should understand how the equity market works. Now you might say, well, what about high short interest stocks? Because don't these stocks that have become meme stocks share that characteristic in common? Meaning a high percentage of their shares in float have been sold short and not covered. And you can look at a list in various places. This is from Dow Jones Market Watch, most recent data, I believe, as of June 15. And I've highlighted Clover Health because we're going to talk about it, one of the most recent meme stocks. Well, is that the reason? Well, you could certainly cause a short squeeze. If a hedge fund has put up collateral to borrow stock and sell it, What happens if the stock goes the opposite direction is that there will be a requirement for more collateral. And if the hedge fund cannot supply more collateral, its assets in the account will be sold. That's a short squeeze in effect. It's forcing people to have to cover because they've outrun their collateral. Well, sophisticated hedge funds are never going to be in that position. They'll swap away their exposure to a Goldman Sachs and never have to deal with that. Plus, it's a false correlation. Sure, it can occur, but it's not the reason this happens. Short interest is it's important to understand this measure. It's a 1974 measure. The federal government in 1971 severed the link between the dollar and gold. So the dollar plunged in value, inflation exploded, financial asset volatility exploded. And so in 1974, in response, the Fed passed Reg T, requiring brokers who are members of the Federal Reserve to report their margin account use. So it would be counted as part of the money supply. And it's never changed since 1974, same old measure. And yet today, you go back then, no electronic markets or exchange traded funds or index funds, wasn't one until December 31, 1975. No high-speed trading, decimalization, Reg NMS, best bid and offer. None of that stuff existed. Well, how would that be a worthwhile measure? Short volume, the one that we use, is from 2009. So let's bring this all together. This is Clover Health as viewed through data from Modern IR. This is what a public company might see. Well, why did our stock explode? Here's what happened in early June. Clover Health has about 113 million shares outstanding, roughly. It's the float. In early June, it traded 700 million shares. Well, how would that be possible? How could it trade almost 600% of the total outstanding shares? Well, we now know there will be two things that happen. Fast traders will explode the volume and trade those things over and over, as the IEX data showed. And son of a gun, look at that. There are orange bars. That is fast trading. That's the behavior. And it's a perfect mathematical arc. As demand surged and then supply demand begin to equalize, then it dips back down, waxes and wanes. And then below it, we should see very high short volume, the manufacturing of stock, and son of a gun, look there. It redlines right into that surge. Well, there we go. We have the language, the rules, and a picture of the data, all of them converging and telling us that those things all match. And that's how it works. So the lesson for us traders is that meme stocks result from rules. Good news is you don't have to learn them all. We've done that. We've spent this time so that you can take advantage of our expertise. Illegal naked shorting is not the cause. Legal naked shorting is. Regulators want a continuous auction market, so market makers must, not may or can, must do it. They must manufacture stock. And you might say, well, so what, Quast? What we care about is trading. What does this mean for us as traders? Well, that's the next step in this equation. So let's move on now, and we'll go take a look at this at app.marketstructureedge.com, or you just go to marketstructureedge.com. And if you've signed up, you can follow along in trial mode and see how this works. So I'm going to switch screens here. It'll take me just a moment, and we're going to go to a different screen to look at this data. Bear with me one moment. All right, let's see here. Stop this switch. Exit. Okay, here we are. Okay. Right. Okay, so this is the platform called Market Structure Edge, and you would land at the dashboard. I've clicked through one of the portfolios at the dashboard called MoneyShow Virtual Expo, July 13th, imagine that. And so this is the portfolio view, and I want to go right to Clover Health. So you'll see it here. What these data tell us are, well, there's the ticker, and it's 1 out of 10. So we use a demand scale called Market Structure Sentiment. That's a 10-point scale. When it's been a 1 for 2 days or 2 or more days, it will be bottom. So it's at the bottom, not at the top. Short volume is about 43% of trading volume. What that means is 43% of the overall trading volume comes from borrowed stock. The overall market is about 45%. So it's pretty close to normal. This figure here, dollars per trade, is about $2,500. That's how much stock Clover Health trades at a time before before the price. That's to keep me on pace here. We're right on track. So that tells us how much stock can trade before the price changes. So imagine if you tried to buy 500 shares of CLOV, and it's yesterday 970 amount, your order would be split into multiple pieces. I tried to buy Microsoft a couple of weeks ago, just 75 shares at the market, and I pay a small commission at Interactive Brokers so I can see where my trades occur. I know market structure, so I want to know that. And it split into 2 trades. And I got intermediated by a high frequency trader on both of them. So they made money in 2 trades instead of just 1. That's how the market works. But it's an important thing to understand about trading. A broker must match about 100 shares. That's the law. So if you're under that and you're at the market, they're going to have to either take the other side of that trade or send it to somebody instantly who can. But you'll know that about $2,500 can match before you have an impact. If it's over that, everybody in the market is going to know. All the machines are going to know there's a disturbance in the space-time continuum. Passive investment behavior, that's indexes, ETFs, and quants. So now we know a fair amount, and now we want to look at the data to see what the trends are. So we know that the demand is bottom. All right, so here's the view. It's going to default to 30 days. And you don't have to look at charts. You don't have to read headlines. You don't have to study fundamentals. All you have to do is understand demand. That's market structure sentiment. And supply. That's short volume, not short interest, the percentage of trading volume coming from borrowed stock. So back here in late May into early June, when Clover Health jumped, notice this. Short volume was very high. Sentiment's rising. Right at the time that the price is about to jump, sentiment is rising over 5. So now things over 5, that's more demand than supply. Under 5 tends to be more supply than demand. You want to own stuff that's above 5 as a general rule. Short volume was right at trend, then spiked. We could go back here and look and we would find fast trading is the key behavior because we've already observed it. And so that's why price shot up right here. It's because shares were manufactured to fill limit orders to buy at higher prices. Now we know that as traders, and you could say, well, I'm leaving there because I know now that it's over. Notice that this short volume right here, see that right there? And then this is almost an inverse correlation of that because that's where the market makers covered. But it didn't jump up above trend again, and the returns are gone. Right, currently, Clover has spent more time below 5 than above it. Well, we can wait until those conditions change, but we know something now that technical traders won't know. There is more supply than demand in Clover, not a great time. But had we seen this, rising demand, flat supply, and then a surge by market makers creating it, we can take advantage of that. It's not perfect. It's rather like Winston Churchill described democracy, the worst form of government in the world except for all the others. And so this is kind of the worst thing in the world except for making stock decisions except for all the others, so to speak. Let me move this out of the way. Now, I want to go to GameStop because this is the seminal meme stock. It's the first one. And I'm going to back the data up a little bit here so that we can see a longer period of time, but it's the same principle. We're going to look for supply and demand so we know whether something will reliably rise or fall. The worst thing that can happen is we buy a stock that's rising and then it gives it all back before we have a chance to leave. And what you will see is, generally speaking, buying when sentiment rises above 5 is very good. You look here in around May 18th, short volume was above trend. There's that manufactured stock by market makers who are filling limit orders. Sentiment rises, hits the ceiling of 10. The stock is still rising, but look at this. Short volume no longer rose above trend. And so you would want to leave as demand begins to wane, even sooner if you have gains. That's how you know if you've got the gains, we'll take them. But you can see the supply demand equation when it's helpful and when it's not. And that's the key. I want to go to Virgin Galactic next because it's in the news with Richard Branson having gone to space, and then of course Virgin Galactic said they're going to offer $500 million or raise $500 million of equity capital by selling shares, and the price goes down. Well, that's apparent in the data ahead of time. So looking at Virgin Galactic, it's at 3.6 right now, and the trend is down. So it's coming down from a peak. Short volume is at about 46%, a little better than the market. The lead behavior is active investment. We'll look at the trend, could tell us that hedge funds are shorting that. Something I didn't mention with GameStop, 60% short, bottomed, active money is the key behavior, tells us hedge funds are shorting that stock. That's what it means. By the way, the behavior is not essential. We bake that into market structure sentiment, but it's helpful to know what kind of money is the lead behavior currently. So let's look at Virgin Galactic because I traded this stock. So back here, right at the end of June, sentiment was rising in the broad market, and I looked at Virgin Galactic and I saw rising sentiment and short volume below trend, and I thought this could probably rise. And it did. I sold it immediately on June 25th because I don't want to stay over the weekend. I just don't prefer that. You never know what's going to happen over the weekend. Plus, short volume had jumped above trend. So I know now that market makers are manufacturing stock to fill retail orders. Well, it could continue to rise and it might not, but I'm happy with this 15% gain that I got. And these are risky trades, but I'm not taking a big risk. I'm using high mathematical probabilities. I know that the stock has been at 10 and did not drop below 5, and then sentiment is rising again from that level, telling me there's more demand than supply. That's what I'm following. It's not guesswork. It's not reading headlines, trying to figure out which direction it's going. I don't have to figure out this pattern or that in a technical chart. All I have to do is look at sentiment. Is it rising? And is supply from short volume level? If demand is increasing and supply is level, price is likely to rise. It's a very simple economic principle. It's not absolute, but it's a good way to think about the market. Finally, I want to finish here and then we'll take some questions. Let's look at Goldman Sachs. It's not a meme stock. Everything else in here is, and there are more of them. Marin Software is fascinating. But if we look at Goldman Sachs because it reported results today, well, what about that? Would that have an effect? Well, sure it will. You know, those things will have an anomalous effect on supply and demand for short periods. But even so, we're going to have a very good read ahead of time. I discussed this with the Benzinga pre-market prep team. I'm on 8:35 Monday Eastern time on Market Structure Monday, and we talk about these things in the application of market structure. If you look up Benzinga pre-market prep show. But here we go. So I talked about how Goldman Sachs's demand equation was falling. Market structure sentiment is declining demand. Short volume is right at trend. There's no benefit. It's not bad, but there's no benefit here. There's no below trend supply and above trend demand. It's the reverse of that, in fact. Yet, as of this morning, before the market opened, supply is increasing, demand is decreasing. No matter how good Goldman Sachs's numbers are, the supply demand equation tells me the probability is the price goes down. Well, sure enough, that's what happened. So that's how the market works. I'm going to just reiterate a few things. Reg NMS is the regulatory structure of the market. It determines how the stock exchanges function, their order types, how broker dealers interact with the market, and you should take it into account. If the most successful firms in the market, Citadel and Renaissance Technology, folks like that, Virtu, Jane Street, very successful quantitative trading firm, are using it and understand it, maybe we should too. And Edge makes this easy. And it's all about supply and demand. Not understanding charts, you can chuck the charts. Just follow the supply and demand equation. It's not perfect, but it's an excellent way to understand how the market functions. Okay, I want to save a little time, Jessica, for questions if we've got them. I'll say again, the best thing for us is to improve our probabilities. That's what we're after. There's no perfect approach to that, but the best probabilities we can get are the ones that we want. So do we have anything, Jessica? We'll answer.
We do. We have some questions. All right, Tim. The first one comes from John. Looks like silver is the current fave stock of the Reddit crowd. How do we tap that through options trades?
Well, so silver as a commodity, John, I'm guessing that's what you mean. If silver as a commodity is the favorite thing of the meme stock crowd, what you can do if you're trading options is create a portfolio very simply here. If we go to the dashboard, you can create a portfolio of silver stocks, publicly traded silver stocks, very easy to find. Create a portfolio, add those, and then if sentiment is rising and short volume is falling, then you want to sell puts, right? Because you want to keep the premium. Unless you're buying them, then you buy calls, or the reverse of that. So that's how you would do it. Everything feeds back to some underlying stocks. We don't track commodities directly because it's a different regulatory structure under the CFTC. than is the US equity market for Reg NMS stocks, but that's the way to do it. And a lot of folks on this platform trade options and use the supply demand equation in the underlying to do it.
All right, great. Eve asks, does the software work on securities with good fundamentals, ETFs or futures?
Oh, absolutely. No question, Eve. Maybe we take an example. Take PEP, which reported today too. In fact, I'll hit this with profile. It won't take long. We'll stop. PEP, Pepsi. I mean, Pepsi's got great fundamentals. It's still the same supply and demand. I liken it to the physiology of a patient in a hospital. Doesn't matter what your physical characteristics are, your ethnicity, under the skin, we're all the same. In the Reg NMS regulated market, all stocks are the same no matter what their fundamentals are, and we'll want to know what the supply demand equation is. Yes, if they stay close, if they stay at 5 a lot, probably core stocks. But if you want to get the best return, buy them when they rise above 5. When they revert to 5, go find something else. That's the best way to combine edge with fundamentals.
All right, great. We'll take one more from Judy. Is there any way to anticipate which stocks are most likely to become memes after the market takes off?
Judy, that it's the toughest thing. The way I think about this is let the crowd tell you which stocks they're interested in. You don't have to capture all the gains. Then use edge to know when you should buy them and when you should sell them. If you can capture some of the gains and avoid the losses when they decline, you don't have to go through the work trying to anticipate where they're going to be. Their actions will tell you. I will tell you that if we look at the FANGs, one of the portfolios that we automatically create for you are the FANGs. We'll know when those things are awesome. In fact, this is what I'm going to talk about in the post-session Zoom call. I'm going to go through a number of these and show how you can keep the gains and avoid when money is moving away from them. That's the best we can do. You could use FinViz, anything, to go see, well, what are people fascinated with today? Then look at them through this lens and say, is there a probability I'm going to get a return? And when those probabilities diminish because the demand equation is falling and the supply equation is rising, leave. That's what you want to do.
Fantastic. All right, ladies and gentlemen, please be sure to join Tim. Once I end this webinar, simply refresh your page and enter the Zoom through the module on the right side of the booth. Tim, it was a great presentation. I really enjoyed it.
Thank you, Jessica.
Hope everyone else did too. Enjoy Zooming. Have a great day. Thanks, ladies and gentlemen, for joining us. Enjoy the post-Zoom.
Thanks, Jessica. Bye-bye. I'll see you guys in a moment.